Good afternoon and welcome to this December edition of the NZX Retail Investor Webinar, the last session of 2020. My name is James Sharp, I'm Senior Relationship Manager at NZX, and we'll be introducing to you our speakers today. Before we get started, just to remind you that we do encourage questions. This is, of course, is a unique opportunity to ask those direct questions you may have to our issuers and industry experts. To ask a question, please do so via the panel where you'll see a question section, and we'll endeavour to answer as many of those as we can after each of the presentations. Okay, to kick things off, as advertised, we are going to be hearing from two of our issuers today in Goodman Property Trust and Vital Healthcare Property Trust. But before that, and to open things up, I want to introduce Mark Lister, Head of Private Wealth Research at Craig's Investment Partners. Mark has a regular presence in the business media and spends time across the country speaking with business people, investors and clients. So good afternoon, Mark. Just wait for him to join.
Yep, you can hear me all right, team?
I can hear you, Mark. Yeah, we'll just wait for you.
Very good. Share my webcam.
There we go.
You can see me too.
Great. I'll come back shortly. Thank you.
Great. Look, welcome everybody. I'm really here to just sort of set the scene and share a few thoughts about the economy, the property sector, and some of the things that we're thinking about in terms of listed property looking ahead to next year. And I'll try and be reasonably brief because you do have two very good businesses that you're going to hear from shortly. I think we've got time for a few questions to myself, so ask away and we'll squeeze as many of those in as we can. But I guess if I just try and really briefly wrap up 2020 so far, been a roller coaster year. The local market fell 30% through February and March. Since then, it's rebounded about 50%, and we sit here today about 10% above where we began the year. So despite all of the challenges, it's actually been a pretty lucrative year for investors. Interestingly, that hasn't been the case across the board. You've had many companies that have been hit pretty hard by the pandemic and the lockdowns. So about half of the NZX 50 is up this year and the other half is down. Most of the property stocks, actually it's been a mixed bag in the property sector, to be honest. You have had many of the businesses across the listed property space do quite well. Vital Healthcare and Goodman Property Trust are two of the examples of companies in that sector that have performed well. Anyone that's sort of been exposed to retail or high-rise office seems to have been hit harder, unsurprisingly. Everyone's working from home and we haven't been going out to shops like we usually would. So that end of the spectrum has been at the weaker end of performances, and anyone involved in healthcare or industrial property or sort of supermarket leases and tenants has been in better shape. So like the broader market, the property sector has been a case of the haves and the have-nots this year. Hopefully next year it's a bit more of a business as usual environment. From my perspective and with our clients, we're managing people's money, whether it's their life savings, whether they're just sort of starting out on their investment journey. Property is a pretty crucial piece of that sort of pie when you think about a diversified portfolio. And some of the things we like about listed property are the obvious ones. Firstly, liquidity is really important. You know, we don't all have $2 million, $5 million to go out and buy a commercial building somewhere and get exposure to commercial property, but the listed sector offers us a way to do that with very small amounts of money. We can put money in, we can take money out very quickly and easily. We can get exposure to a wide range of assets, a wide range of tenants right across New Zealand, and we can do that easily and gain exposure to assets that are at a level of quality that the average person, even a very wealthy person, just wouldn't be able to ever do. You know, you think about assets, whether it's one of the hospital assets that Vital Healthcare owns, or whether it's Highbrook Business Park that Goodman owns, or you know, the Commercial Bay in Auckland that Precinct owns, or Sylvia Park or the Vero Centre that Kiwi owns. You can't get exposure to those unless you really are very, very well heeled and well capitalised. So it's a great sector for people that want to get exposure to commercial property, but with a small amount of money. I guess other things that make it highly attractive is high levels of income. You know, the dividend yields across the sector pre-tax are about 5%-ish, give or take, some higher, some lower. And those yields are very tax efficient. Since the PI regime came into being in 2007, for retail investors, for New Zealand investors, it's a very efficient way to generate income, because the tax that you'll pay, well, you won't pay any additional tax on your dividends you get from your listed property investments, which means that your personal, it's irrelevant sort of what your personal tax rate is. You don't need to worry about any of those sorts of IRD issues. It's very easy and seamless and attractive from that perspective. And you do have the scrutiny of a lot of very smart fund managers and investment analysts that are keeping tabs on these businesses. So Andy and Aaron and James, who you'll hear from soon, they probably spend half their time talking to very well qualified, well-informed analysts that are on their case, making sure that they are using their shareholders' capital wisely. So you can have that level of comfort that you're just not going to get by investing in syndicates or sort of in the unlisted space. There are some good operators in the unlisted space, but it's generally higher risk. The asset quality is not as good, and you do open yourself up to more potential sort of what could go wrong. I think we've even had a couple of operators just in the press in recent days that have sort of run into trouble. So I think if you're a small investor, or even if you're a big investor and you want to get access to that broader commercial property spectrum in a very easy, cost-effective, tax-efficient way that will give you high levels of asset quality and broad diversification, the listed property sector is a very good option. Looking ahead to next year and how we're thinking about the economy generally and listed property, look, we've got a pretty glass half full view of 2021. We think that the vaccines are genuine, and we will see those make a credible difference, probably second half of next year at least. So we are looking at an economic rebound. We're looking at a reopening of many parts of the global economy. I think central banks, including our own, will keep their pedal to the metal in terms of support and stimulus. So we don't have to worry about the OCR rising and sort of destabilising things. That lower for longer interest rate theme is here to stay, at least in terms of short-term interest rates. And the political backdrop is reasonably friendly in financial markets as well, with a business as usual outcome in terms of our election, and also an election outcome in the US that I would see as the best of both worlds. So I think you know, we will see ups and downs, we will see challenges, and it will be a bumpy ride. That's what share markets are like. But I think next year will be another reasonably positive one when we think about sort of economic growth and how financial markets are positioned. I guess in terms of the property sector, you know, there is potential that the property sector is one of the laggards looking across the New Zealand share market if you do get that reopening enthusiasm, because investors will look towards some of those more exciting, economically sensitive businesses or sectors that have more leverage to a recovery. But at the same time, I still think it's a great place to be, because you get that predictability of income and that sort of diversification of sort of asset quality. And I think with interest rates at very low levels, you will see ongoing growth in asset prices. Things that could go wrong would be longer term interest rates. A lot of people buy these vehicles for yield and for income, and if you see longer term interest rates rise on the back of an economic rebound, then that could sort of maybe give people other options in terms of fixed interest bond markets. But I can't see anything happening in that regard enough to really destabilise this listed property story. I still think it's a sector that is pretty well positioned. I think asset prices will continue to rise. They have been this year, and I think that'll it'll be something that continues, and you could have a bit more of a broader range of performance. Well, you could have more of the sector do well rather than sort of the same divergence this year if we do have a more year. So the sorts of things I'll be looking to hear from if I was in your shoes and about to hear from these two good quality listed property companies will be how they sort of see the outlook for their own business and their own segments, what they're looking to do to sort of add value in terms of new developments, where they see asset prices going, because the NTAs obviously are a function of where asset prices are going, how that flows into sort of fees and so forth, and whether there's any sort of rental growth, earnings growth in the horizon, because at the end of the day, that's what we're all looking for. We're looking for steady, consistent dividend growth to come out of these businesses, and that's how we'll get some long-term returns. So maybe those are a few ideas about sort of how the line of questioning could be from Andy, James, and Aaron. I'll maybe stop there. I think I've probably finished a few minutes early, so happy to take a couple of extra questions if you're ready, James, to get the ball rolling.
Great, thanks, Mark. Well, we do have a question you may have already answered, but just to reiterate. So within the property sector, what are some of the key things to look out for when considering making an investment? So I think you mentioned those already. So if you want to just reiterate those points.
Yeah, I guess the things we look for in a listed property vehicle, we look for good management and good governance. So we want to see evidence that the management teams are thinking about shareholders, in particular small shareholders, and acting in their interests. That's something that's really important to us. We want to see good quality assets. We think that, especially in real estate, it's all about quality. And if you've got good assets and good locations, you'll attract very good tenants, and that sort of leads to more resilience, more defensiveness, a lower risk profile, and hopefully sort of steadier and more attractive rental growth over time. We want to see reasonable levels of debt within these businesses. We don't want them to be up to their eyeballs in debt. We want them to have modest levels of enough levels of gearing that they sort of do have an appropriately geared balance sheet, but we want them to have some spare capacity and firepower for other projects that they might look to. We want to see growth options. Goodman in particular has been very successful over the years at sort of value-added developments that have built out a very good portfolio, and I think it all boils down to earnings and dividend growth. That is really what you're here for. You don't want to see earnings and dividends that just sort of stagnate or go sideways. We want to see that earnings and dividend growth come through. We're not buying for this year's yield. We're buying for the yield in 3 years, 5 years, 10 years time. So we want to see those yields rising, and that's where we don't want to generate returns just because interest rates are falling and everything's getting more expensive. We want to see that genuine growth coming through.
Okay, great. Thanks, Mark. We do have a few questions here, so we might not get through all of them. This one, quite a short one. What is the minimum investment amount required when investing, adding that in via Craig's investment partner?
There's not really any right or wrong answer there. I mean, if you're just a broken client and you sort of come in and walk into one of our offices and you want to sort of just do a trade, then people would do that with $500, $1,000. There is sort of a brokerage rate though, so it's more about just having a sort of more economic parcel size. But for people that have got even less than that, we have a product that we call our Start product, which is sort of a drip feed product where we have a menu of sort of 200 companies around the world, including the two you'll hear from shortly, and you can drip feed at what's the minimum? $100 a month, so sort of $25 a week, which is pretty accessible for everybody, and it's not dissimilar to what you're seeing, the likes of Shares and Hatch do these days, but that's a product that we've had in place since the 90s. So, you know, we've been doing it for a while now, and it's sort of a fractional and investing product where you can sort of put your $25 a week into Goodman Property Trust if you want to. So there are different sort of products and offerings that suit sort of different types of clients. So, you know, it's definitely a myth that you can only sort of come to a financial advisor like ourselves if you've got $2 million. That's not the case. There are a range of products to suit people that are at different ages and stages.
Okay, great. Thanks, Mark. Another one here. The US election result further reinforces the global context affecting all sectors of accelerating responses to climate change. How should we think about climate change impacting on the property sector investments?
Yeah, good question. And it's a really hard one to answer. I suspect that the speakers you'll hear from shortly will give you a much more detailed and useful answer than I will. But I think, like all industries, if we want to deal with climate change properly, then we do need to accept the fact that you know, it is going to put additional costs on our costs of living, and potentially lower our standard of living in places, because that is the trade-off that we sort of all have to make. And when you think about property, I guess as an investor, if you wanted to invest in a way that's very sustainable and from an environmental standpoint, you would want to target your investments towards property businesses that have, I'm not sure what the terminology is these days, whether it's green buildings or the sort of 5-star, 6-star ratings that you see across the property space. So for those that want to put their money where their mouth is and support property businesses or landlords or property owners that are providing those sorts of premises, then you'll need to do your homework and make sure that you are, you know, supporting those businesses that do have those sorts of buildings and properties. And I think by and large, the listed sector does a much better job at that than the unlisted sector or some of the syndicates out there that tend to focus on buildings that are a bit lower quality, a bit older, probably aren't quite as sustainable, and aren't sort of as fit for purpose in that sort of modern world.
Okay, great. Thanks, Mark. We've got time for a couple more minutes, so just time for one more, and we will endeavour to get back to questions that we haven't got to now. Yeah, what are the risks of investing in listed property stocks when they're mostly trading at premium to NTA?
Yep, good question. So look, they do look expensive relative to their asset backing or their NTA. I'm sure you'll hear about that soon. I guess one thing you do need to bear in mind is that the NTA or the asset backing is sort of a lagging indicator. So I think as you see more transactions take place in the market and as valuers get more comfortable with where valuations have moved to, I wouldn't be surprised to see sort of those NTAs rise over time. So maybe they will catch up to, or the gap might close between share prices, or the usual risks apply. I mean, this year has been a perfect example of the risks of listed property. You know, if you have the wrong tenant in the wrong space and the wrong sector, and they run into trouble, they can't pay the rent as easily. You have to give them sort of a rent holiday, or maybe they go out of business and they leave, and you're left with an empty building. That's obviously going to be a problem, and that leads to less revenue coming in the door, and sort of your dividend falls, and it often reduces your the value of those properties. So all of those business risks apply. I think the real big one out there is probably interest rates, and this is not just for the property sector. This would be for the housing market, it would be for utility stocks like Meridian and Contact, asset prices generally. They are all very well supported because interest rates are at very low levels. So if we did see a change in that economic, inflationary and interest rate backdrop that saw interest rates rise back to something more normal, then I don't think share markets generally, or listed property or commercial property or houses for that matter, they wouldn't be able to stay at the same level. So for me, sort of one of the things to keep in mind over the next few years is what does the path of interest rates look like? And over the next sort of 1, 2, 3 years, I can't see any pressure at all on central banks around the world to sort of lift interest rates. But if we do sort of get an inflationary spike from all of the money printing and all of the other liquidity that's sort of sloshing around in the world, and if you get a bit of a economic recovery take hold, and interest rates go back to something more normal, then you could argue that that will sort of see income generating assets maybe come under some pricing pressure. So that's maybe a watch the space for the future.
Great, thanks, Mark. We do have other questions. As I said, we will try and get those over to Mark. But Mark, thanks very much for joining this morning, this afternoon, I should say. Really insightful. Enjoy the rest of your afternoon.
All right, thanks all. See you later.
Cheers, Mark. Okay, now on to the first of our 2 issuers this afternoon. So firstly, we're going to hear from Goodman. Goodman is a global property group listed on NZX, who in New Zealand under Goodman Property Trust owns, develops and manages modern, high-quality industrial and business space with a portfolio of $3.3 billion. And it's a pleasure to introduce Andy Eakin and James Spence, respectively, the CFO and Director of Investment Management at Goodman Property Trust. Good afternoon, gents. And again, I'll come back in a few minutes with questions.
Great, thank you. See if I can just make this work. Can you see my screen okay, the slides?
Yep, we can see fine. Great.
Excellent. Good afternoon, everyone, and thanks for joining us today. So look, I'm Andy Eakin, I'm the Chief Financial Officer, and I've got with me James Spence, who's our Director of Investment Management. And we'll sort of switch between us as we go through this. Look, first thing I wanted to do was sort of set a bit of a scene around Goodman Property Trust and how it relates to Goodman Group, which is Goodman Group is the manager of the Goodman Property Trusts. The trust itself listed on the NZX here in New Zealand. Goodman Group that manages the trust is listed in Australia. And you'll see on this map of the world the countries that Goodman operates in globally. Goodman is a specialist logistics and industrial property developer and manager. And manages funds similar to GMT all around the world. The one point of difference with GMT, Goodman Property Trust, is that we're listed, whereas those other funds globally are unlisted. In total, over $50 billion worth of logistics and industrial property managed globally. And within New Zealand, we've got $3.3 billion of real estate that's managed here. So just looking at some of the key stats around the New Zealand business, these are as at 30 September, so our interim reporting date, which was reported about a month ago. The occupancy across the portfolio essentially full, 99.7% occupied, very little vacancy there. Total size of the portfolio, we've got 1.1 million square meters of floor area, and the market capitalization of GMT, $3.3 billion. In terms of the properties that we've got under management, so these are the groups, the estates that we manage, where we've got a collection of properties in one location. There are 11 separate estates, and those are throughout Auckland. And the trust is 100% focused on Auckland industrial and logistics properties. Managing your investment and those properties, there are 60 people in total within the business here in New Zealand. So look, over the last 6.5 years, we've had a very deliberate repositioning of the portfolio. So historically, GMT invested a little bit of its investment in Christchurch, around 10% if you go back about 10 years. And we also invested within the Auckland office market, not core CBD, but in the viaduct and in the suburban office market. About 6.5 years ago or so, we made a decision to focus 100% on the industrial and logistics real estate class within Auckland. And as you can see in the chart there, over that time, we've sold $1.2 billion worth of assets that we had previously and reinvested the proceeds from that into $1.3 billion of acquisitions and new developments on the greenfield land that we had within our portfolio. It's a young portfolio as well, so about 80% of it built since 2004, so built by Goodman. And I think that represents a very high quality portfolio. And look, I'll hand over to James, who'll talk a little bit more about that.
Thanks, Andy. Good afternoon, everyone. So I might just touch on some of the global trends that is happening in the industrial markets, and that might give us an idea as to where we're heading in New Zealand, give us an idea of the future. So 3 key trends impacting on the global industrial and warehousing market are the increased urbanization, e-commerce and customer expectations, and technology and automation within warehouses. So to start on urbanization and consumption, so cities currently house around 50% of the world's population and generate around 80% of global GDP. It is anticipated that this will continue with more people living in cities and getting to about 70% of the world's population by 2050. And if you look 100 years earlier to that, back to 1950, it was about 30% of the world's population was living in cities. Obviously, there's many arguments about how COVID will impact on the long-term growth of cities, but our view is that the growth continues. However, the way in which we live within cities may change. Travel and distribution across cities may become a thing of the past, with companies and communities more focused on local neighborhoods and potentially local fulfillment of goods. Consumer expectations continue to increase all over the world, and while New Zealand's shipping times for online spending remain relatively relaxed, something like 40% of global consumers are willing to pay more to get same-day delivery. We think these things are going to impact strongly on the demand for inner city logistics and warehouse space, and that's transformed overseas markets, but yet to happen here in Auckland yet. Obviously, there's been a huge surge in e-commerce sales globally, and that was on a rapid increase pre-COVID, but COVID's probably compressed that e-commerce expansion of maybe 2, 3, 4 years down into a couple of months or into 6 months. New Zealand's online spending is up around 28% year to date, and now we're sitting at about 11% of all sales in New Zealand are done online, and that was sitting at around 7 to 8% a year ago. Now that's important for our market, and what we've seen in global markets is e-commerce users and customers that are using more of their warehouse space for online, they need more space than a general occupier. They carry more SKUs and more inventory, but they also need a bigger space to handle customer returns, which can be up to around 1/3 of the warehouse. If you look back 8 to 10 years ago, the UK was in a similar position to us, with around 11 to 12% of their sales being online, and they've gone to 20% now in 2020, and over that same period, warehousing demand is up 90%. If you look in the US, big box or big warehouses demand is up 50% for this year alone, and we haven't seen that happen in the Auckland market or the New Zealand market yet. Actually, 2018, 2019 net absorption numbers for warehouse space was below that of the years prior, so yet to hit us here. In terms of another trend we're seeing is, customers and our distribution companies heavily investing in technology and automation to keep up with the influx of and increasing demand of goods through the same warehouse spaces. COVID in New Zealand, and especially the first lockdown, pushed a lot of our occupiers and customers and distribution companies in New Zealand to the limit. And while things have calmed down a bit, I think they're realizing that within 2, 3, 4 years, they're going to be back to those levels again, and they need to get themselves sorted. So that involves, making sure they're investing in their warehouses and automation. And that has a big impact on commitment times and spaces for potential occupiers and warehouses. So GMT in New Zealand, as Andy mentioned, listed on the NZX, and it's a $3.3 billion portfolio across 11 estates on 250 hectares plus of land and buildings within about 20 kilometres of Auckland CBD. It's a high quality portfolio focused on urban logistics, and as you see from the map there, our estates are not only well connected to the transport infrastructure, which is important, they're also close into the end consumer base and the people living in houses that actually need the goods out of these warehouses. The next slide here provides an overview of our top 10 customers. About a third of the portfolio is focused on storage and distribution, and you'll see our largest customers there: NZ Post, DHL, Office Max, a lot of names that you'll know, and NZ Post account for around 7% of our total portfolio income. If I just touch on COVID and the impact to the portfolio, obviously the original level 4 lockdown back in March, April for the 33 days had by far the most significant impact on our customers, with a lot of them not able to actually access their warehouse. Around 60% by number were actually having to close their doors completely. Level 3 in New Zealand is a much different story for us, and it's close to sort of 98–99% of the portfolio is open. Lockdowns triggered a lot of rent relief requests from our customer base. We've got 200 customers within the portfolio, and our response was to really support our most vulnerable customers. It's those 35 to 40 smaller customers within the portfolios that were the hardest hit, and that's cafes, restaurants, gyms, those like the sort of amenity to the estates. Recent conversations with our logistics customers are that they're doing well, and demand's there and demand's strong, as I'm sure you've all heard through anecdotal stories. However, as widely publicised, a lot are struggling with supply and getting their goods here. It's not only actually getting the goods here, it's about the uncertainty as to when they'll arrive and not being able to promise their end customers when the goods will be here. So over the last few years, we've been targeting new investments that provide a future development pipeline. Development's been a big part of our sort of game here in Auckland, and we have had a land bank which used to be 15% of our portfolio. That's now wound down to about 1 to 2% of the portfolio, as we've built 30 to 40,000 square metres of warehouse space. We're restocking that pipeline by buying infill sites like the one you see on screen here. So sites that work in terms of location, close into the consumer base, generally next to our existing estates, and generally with income. And over the last 6 months, we've purchased $83 million of real estate, including this Savile Link extension here, with a total site area of around 14.5 hectares. They're currently leased with their existing improvements providing a steady holding income, but also a development pipeline going forward. But let's touch on our developments. Completed 2 developments in the last 6 months, a 7,500 square metre warehouse expansion for Office Max, which came alongside a 15-year lease to Office Max for them to recommit at Highbrook. And we completed 3 units at the bottom there on your screen at Savile Link and Otahu, which are fully leased. The 2 projects completed in the period produced around $8.5 million of development profit for the trust, reflecting a margin of around 20%. We currently have 6 projects ongoing across Highbrook, Westney and M20, totaling around 30,000 square metres, and just last week we announced a further development at Roma Road for a 17,500 square metre pre-commit on a 20-year lease that will be commencing early next year. And back to you, Andy.
Thanks, James. So look, I'll just touch briefly on some of the key financial results points that we released, as I said, about a month ago. So looking first of all, this slide, the financial highlights, we reported a profit before tax of $186 million, and a major contributor into that was a full portfolio revaluation that we completed at 30 September, and the portfolio lifted in value by $140 million. Mark talked before around the net tangible asset backing that you should consider within a property investment. So the value of our real physical assets on a per unit basis was 182 cents per unit after allowing for that revaluation gain. One other thing just in this slide I'll mention now, because I'll come on to some of the other points in a moment, the net property income growth. So again, Mark talked about looking for growth that you see in the net property income or the revenue. So 4.2% higher for the first half this year compared to the first half last year. So cash earnings is the measure that we look at as our preferred performance measure. So this really looks at the underlying income generated by the business after we've paid the expenses. And in the first half of the year, cash earnings was 3.11 cents per unit. We gave guidance at the beginning of the year that we expected it to be around 6.2 cents per unit for the full year. So we did achieve exactly half of what we guided at the beginning of the year. And this was despite the fact that we had provided relief to customers to support them through COVID, but offset by some positives on the other side, not least around lower interest rates. We have had some more confidence around what the second half looks like, and when we came out with the result, we did increase our full year guidance from 6.2 cents per unit to at least 6.3 cents per unit, because we see a more favourable outlook through the second half than what we'd originally anticipated. Distributions paid for the first half of 2.65 cents per unit, and that reflects a new distribution policy that we brought in at the beginning of this year, where we expect to distribute between 80 and 90% of our cash earnings each year, retaining the balance of that to cover capex within the portfolio. So that's capitalized a capital expenditure on our stabilized portfolio, so the assets that are currently leased and generating rental income. If we look at the total investment property portfolio, so these are the assets that we own. The green bars, portions of those bars represent the stabilized portfolio, so the currently income producing assets that are leased to our customers. The orange bar are the active developments that are underway, and then the small blue part relates to land. So you see at 31st of March, we were sitting just over $3 billion worth of total property, investment property, and at 30 September, that had increased to $3.3 billion. Fairly even split between what contributed to that increase. So the acquisitions that James talked about, plus developments that we completed through the period, alongside the revaluation of the portfolio, bringing that up to $3.3 billion total. Gearing is another important measure that we look at, and Mark mentioned this as well, around having sensible levels of gearing within a business. We've got a medium-term preferred range for our gearing of between 25 and 35%. And over the last few years, it has been lower than that, and that's as we've sold out of some of those assets that I mentioned earlier, predominantly the office assets here in Auckland. And then last year, just over 12 months ago, we raised some additional equity, which again lowered gearing a little at that time. But as you can see, from March to September, gearing's gone from 19% to 21.5%. And if you take into account the developments that we have underway and the spend that we've got yet to incur on those, that takes it up to 22.3%. It is a conservative level of gearing, but it's something that we're very comfortable with. It provides us with very significant resilience in the business if asset values were to fall, and also provides us with capacity to go and borrow some more money to fund did the connection get restored there? I think it did, yeah. So it allows us to... Yeah, you can hear us great. It allows us to go and invest not only in the developments on the land that we already own, but to invest as we have done over the course of the last 6 months. Then looking at the sources of debt that we have, so something that we're really focused on is maintaining a very diverse debt book. So we have 4 key sources that we draw on currently. So retail bonds that some of you may already invest in. Those are the green components on the chart that you see. And we've got one of those maturing middle of next week. We've got bank facilities that we have available essentially for working capital, and we can draw on those as we acquire things and develop. And then the longer term debt, the blue components, debt sourced in the United States through the US private placement market. And during the first half of this year, we completed 2 wholesale bonds at 8 and 10 year terms that you can see on the chart there. 100% of our debt currently drawn from non-bank sources, so we have the full $400 million of bank facilities available, and that'll be used to repay the bond next week, but also for those developments and any acquisitions that we may complete. So if I just take a brief look then at how we see the outlook for things. Look, COVID has certainly changed very dramatically the way we live, and certainly through the lockdown periods, how we had to work through those periods. And as James has talked about, we've seen real change in how people consume as well. The properties that we own really play a very key role within the supply chains. You know, they're often not realized just how critical they are whenever you want to acquire something, you want to go out and shop, whether that's online or actually in stores. But they're a very, very important part of those supply chains. And we've seen the business perform incredibly well through this period. The resilience that we ensured that we had within the business has stood us very well through the last 6 to 9 months. And that, along with the the slightly more positive outlook, is what's given us the confidence just to lift that earnings guidance for the balance of the year. So I can hand back to you, James, and happy to take any questions.
Great, thanks very much. We do have a few questions, so we probably don't have time to ask all of them, so we will get those over to the guys at Goodman after the session. But if we just pick one here, is there a positive NPV for filling those Auckland warehouses logistics roofs with solar panels? If not, what are the issues?
Yeah, so look, this is something that we've been doing work with a number of our customers on. And increasingly solar is becoming cheaper to install. The scale of those facilities, the solar installations, the larger they are, the more cost effective it becomes in terms of effectively the price of the electricity that you're generating. And we're definitely seeing I think an inflection point where we do see positive returns from doing that, and you'll see that. And if people watch our portfolio develop over the next few years, you'll certainly see that as a very key part of the investment that we put into not just the new buildings that we develop, but also some of the existing portfolio as well.
Great, fantastic. We probably run out of time for the other two questions, but I'm going to send them through to you if that's okay, and we'll get the answers back to those who've asked it. To both of you, thanks very much for joining this afternoon, and speak to you soon. Enjoy the rest of your afternoon.
Thank you. Thanks, everyone. Thanks, James.
Thanks, guys. And to our second and final issuer now, Vital Healthcare Property Trust. So VHP invests in healthcare medical related properties in New Zealand and Australia, is the only medical healthcare property investment fund that's listed on NZX. And from VHP, I'm joined by fund manager Aaron Hockley. Good afternoon, Aaron. All yours. I'll come back in a few minutes with some questions.
Fantastic, thanks, James. Can you see my screen?
We can.
Okay, fantastic. As James mentioned, Aaron Hockley, I run the Vital Healthcare Property Trust. We're a specialist, NZX listed owner of healthcare real estate across Australia and New Zealand. Vital is managed by Northwest, which is one of the largest global healthcare specialist property fund managers. And in this region, it essentially manages properties across two funds. There's Vital listed here in New Zealand, and there's also a joint venture with a Singaporean sovereign wealth fund in Australia that owns other hospital assets. Together, across both the platforms, we have 40 healthcare real estate professionals in this region, managing assets for a number of unit holders. In Vital, we have a portfolio of $2.2 billion, split between Australia and New Zealand, roughly 3/4 in Australia and 1/4 here in New Zealand, which has been amplified following a recent acquisition. That's split across 42 properties, the bulk of which are in private hospitals, but we also have some exposure to outpatient facilities and aged care. We have an 18.5-year WALE or WALT, so that's your weighted average lease expiry term which is the longest by far in the sector and the longest by far in either Australia or New Zealand for any listed vehicle. And that really provides the income security for our investors. For FY20, we recorded net property income growth before any foreign exchange impacts of 3.4%. Around about half of that was natural income growth in the portfolio, and the balance was contributions from developments and acquisitions, really highlighting why we're so focused on continuing to acquire properties, but also continuing to develop properties. In terms of portfolio strategy, we're very much focused on true healthcare, and so we focus on something that's called acuity, which is essentially the level of care required. We're focused on assets where you actually receive healthcare from, rather than it just being a healthcare tenant. So we focus on aged care, not retirement. We focus on hospitals, and we focused on precincts where medical professionals, surgeons, etc., are operating on a day-to-day basis. We're largely agnostic between Australia or New Zealand. The investment climate, the underlying fundamentals are good in both places. There are some key differences, but overall at the moment they screen very well. And everything we're doing is really designed to support our underlying growth target of 2 to 3% per annum per unit. So we're trying to grow unit holders' distributions and the earnings per unit by 2 to 3% per annum, and that's really the core focus for us. A little bit more on our portfolio strategy. So hospitals, and at the moment it's all private hospitals, make up the core part of our earnings. So 82% as at 30 June, and we're targeting keeping that between 50 and 70% as we continue to grow. That's not anything negative around hospitals per se, it's just that hospitals are infrequently traded. It's harder for us to continue to acquire hospitals. So it's more likely that our future growth will come outside of hospitals in particular. So the three growth areas for us are really outpatient facilities. Currently, approximately 12% of the portfolio is in outpatient facilities. If you think about consulting suites that might be next to a hospital, areas where you don't have to check in and require a bed, but you receive healthcare from. So we're targeting 10 to 20% of the portfolio coming from that subsector. Our third target area is aged care, currently representing about 6% of the portfolio, all of which is in Australia. We're really seeking a relatively limited component of the portfolio exposed to aged care, so really the premium end of the market, probably not for profit, or that's where we're focused at the moment, but we would consider New Zealand as well. And the final section is what we call life sciences or research, and that's really, if you think about universities or biotechnology, pharmacy, etc., that's a new growth area for Vital. It's a big asset class overseas, and so we expect it to be a growing asset class in this part of the world. And as I said before, all of our investments are really targeted to provide that earnings growth from a diversified and defensive asset base. So looking to some recent operational highlights, we had a 5.6% in our cash earnings, or AFFO per unit, in FY20, and that allowed us to meet our distribution guidance. We have released distribution guidance of at least 8.75 cents per unit for this financial year, so that is flat from last financial year. That was because we released that at the height of COVID, and had some concerns at that point in time, but we'd be hoping to improve that and to meet our guidance or target of 2 to 3% growth per unit per annum. We recently undertook an equity raising, which reduced our gearing to around 33%. In terms of the portfolio, over 99% of rent was collected in FY20 and the first quarter of this financial year, despite COVID-19. As I said before, we do have that market-leading 18.5-year WALT or WALE. We recently undertook $100 million of asset sales, which I'll go through shortly. And then on the acquisitions and development sides, we undertook $71 million of acquisitions in FY20. We've got 9 developments underway, and we recently acquired Grace Hospital in Tauranga, New Zealand for $95 million. So thinking about COVID-19, as I said, 99% of rent collected, which is well above our peers in both New Zealand and Australia. And the majority of our tenants, being some of the largest hospital operators and other healthcare providers across New Zealand and Australia, have largely recovered to their pre-pandemic operating levels. And that really highlights the importance and resilience of Vital's assets and how crucial our tenants are really to the functioning of healthcare in both countries. Initially, in the early stage of the pandemic, governments in both countries shut down elective surgery in particular, and that had a huge impact on a number of our tenants. And they subsequently realised that wasn't sustainable, and they quickly opened up and kept elective surgery going. Despite COVID-19, we undertook a $157.5 million equity raising last month, which was significantly oversubscribed, and we're investing that into our development pipeline. The bulk of our investors continue to be attracted due to our income security. Our developments continued, albeit slightly slower, and operator patient demand remains high. As I said, our distributions were paid consistent with guidance, and we've managed to maintain distributions consistent for this financial year as well. And over the 12 months to 30 September 2020, we recorded a 12.7% total return, which was 17.1% above the index. As I said, we recently acquired Grace Hospital in Tauranga for $95 million. This is a premium hospital, 51 bed, 11 theatres. It has significant development opportunities. We have agreed with the tenants who we acquired the asset from to undertake a $50 million expansion subject to certain conditions being met over the next 5 years. The tenants here are Southern Cross and Evolution Healthcare, respectively, New Zealand's largest and third largest private hospital operator, and the lease is 30 years. So again, providing that income security for unit holders. Grace Hospital is the only private inpatient facility in Tauranga, and it was acquired well below replacement costs. So it's a strong asset that we expect will perform well for unit holders over time. To fund that acquisition, we have sold 3 regional assets in Australia. They're largely rural assets. We were able to sell those at a 14.7% premium to their book value. The WALT on those 3 assets was 15 years. So the acquisition of Grace was nearly double the WALT for Grace is nearly double the assets sold. And we expect that the proceeds being redeployed will produce higher risk-adjusted returns for unit holders, which is really the whole point of our portfolio development program. As I said, we recently undertook a $157.5 million equity raising. It was primarily to existing holders. We tried to preference a wider pool, so retail holders in particular had a 127% over allocation, and a number of brokers in particular as well oversubscribed. We did have to scale people back, and that was primarily on their holdings on record date. The proceeds have been initially used to reduce balance sheet gearing to 33%, but ultimately they'll be deployed to fund our existing development pipeline. Got a couple of developments that are here, but conscious of time, so I won't run through in detail. We're expanding and seismically strengthening Wellington's preeminent private hospital, Wakefield. That's roughly $130 million development over the next 2 years, of which Vital's contribution will be a bit above $100 million. Royston Hospital and Hastings in Hawke's Bay, two developments essentially side by side. One is the expansion and upgrading of the existing hospital, and the second is the day surgery unit next door to that, and that'll have a value on completion of $75 million. Epworth Eastern in Melbourne, which is Vital's largest asset, this is being upgraded due to finish next year, graded and expanded. You can see in the top left-hand picture the tower that's being built, and the precinct value for Vital overall on completion of the tower will be about 380 million Australian dollars. So it's a very significant asset by itself, but also significant in the context of the wider precinct. Our comparative returns I spoke about, both for the last year, but also running back for 10 years plus, we continue to significantly outperform the real estate index. And finally, in terms of an investment in Vital, I mean, we are the only listed specialist owner of healthcare property in New Zealand, and there's no ASX listed equivalent. We do provide investors with exposure to both New Zealand and Australian property, so there is we are complementary to the other listed property vehicles like Goodman. So if you own both of us, you get exposure to both industrial, New Zealand, healthcare, and Australian. We're less impacted by economic or business cycles, as been shown through COVID, and the aging demographics, rising life expectancy, and improvements in technology all support investment in our sector. And finally, earnings growth. We are targeting that 2 to 3% growth per annum. We do expect over the longer term that that's where investors should get the bulk of their returns from. So notwithstanding some significant property revaluations over the last few years, at some point they have to come to an end, and we expect that it'll be earnings growth that provide the returns for investors. Finally, I just want to respond to one of the questions on NTA and an investment in a property vehicle, given where the sector is trading, and including us, we're roughly a 20% premium. I think it's important to bear in mind that not only the lag impact that was spoken about earlier, but also you're effectively paying for management. There's a price for diversity, so you're not just buying one asset. In our case, you're buying into 42. There's also a price for listing, because there are costs involved in having a listed vehicle, which provides liquidity and the initial costs. And finally, which is particularly relevant for us, there's stamp duty on all Australian properties, so 5.5%. So that's a significant cost foregone, which you would have to pay if you were investing direct, which isn't counted in that calculation. And that's it from, that's all I had. Happy to take questions in the 2 minutes we've got.
Thanks, Aaron. Really great stuff, and thanks for just referencing that previous question as well. Really useful. We do have time for just one. So question has come in. Does Northwest manage any other listed property vehicles anywhere else in the world, and how does Northwest's expertise and experience translate to VHP in Australasia?
Yeah, so much like Goodman, the parent is listed in Canada, so it's listed itself, but all the other investments are co-investments, typically with one or two investors in other countries. So we're the only other listed vehicle that's managed by Northwest. It does provide a lot of expertise in two key areas. The first is that if I was just running this fund by myself, with my colleagues in Auckland, I wouldn't be able to draw on the wider expertise. I wouldn't be able to afford to pay the over 40 investment professionals that we have in this region. So that's a significant benefit. And the second is just that global expertise. So we follow global trends. And a lot of what we're seeing in North America and Europe, we're able to apply those learnings into this part of the world, and vice versa. They're applying what we've learned over here, and you get that information sharing, which again, if I was sitting here by myself running the fund, I wouldn't have access to all of those learnings.
Okay, Great, thanks for that, Aaron. It's bang on 3 o'clock, so we're just very punctually finished there. Appreciate you coming on this afternoon, Aaron. Thanks very much, and enjoy the rest of your afternoon, and enjoy the rest of the year, and have a great Christmas, New Year. And then to everyone joining today, thanks for joining this. As I said, the last instalment of 2020. See you again in 2021, where we'll be kicking off the retail investor webinars in February. Yeah, finally from me, thanks again. Have a great Christmas and New Year. Bye-bye.